All right, welcome to the deep dive. Today we're going to be diving into something, well, frankly, a topic that's been generating a ton of buzz, cryptocurrency, and specifically its future, its long-term viability.
A lot of hype, a lot of speculation, but what's the reality?
Exactly. And that's where you, our listeners, come in. You shared Elliot Terner's thesis with us, The Future of Cryptocurrency, and it's a really solid academic deep dive.
It aims to cut through all that noise, all that hype, and really assess, the real potential here.
So that's our mission today, to break down the key takeaways from Turner's work, to understand if cryptocurrency has a strong foundation to really last, and what a future with wider adoption might actually look like, for society as a whole. No easy feat. But we'll do our best to keep things clear and concise.
Absolutely. Let's start with the basics.
Sounds good. The foundation, right? Blockchain technology. This is where it gets, fascinating, I think. Turner argues that blockchain isn't just a part of cryptocurrency, it's the entire underpinning.
It's the bedrock. Think of it as a new type of digital record keeping, a ledger that's not held in one central location. And most importantly, it's designed to be tamper-proof.
Immutable.
Right, precisely. Once a record, a transaction is added to this digital ledger, it becomes extremely difficult to alter or erase. That security comes from how the data is structured.
Okay, break it down for us.
Sure. Information is grouped into blocks, and these blocks are linked together, chained together, using something called a hash value.
A hash value.
Think of it like a unique digital fingerprint for each block.
Okay, so each block has its own fingerprint, but it's also connected to the fingerprint of the block before it.
Right, a digital chain. Each link knows the one that came before it. Each block contains the hash of the previous block.
So if someone tried to change information in a block, like way back in the chain, its hash would change. And because the following blocks all have that original hash, it would break the chain. Everyone would see it.
Exactly. It would be immediately obvious to everyone on the network. Very difficult to manipulate the system.
That's incredible. Now, Turner also mentions these Merkle trees. Is that a little intimidatingly technical? But what's the basic idea here, and why should we care?
It is technical, but it's actually quite elegant. A Merkle tree is a data structure within each block that allows for very efficient verification. Imagine a block filled with, say, hundreds of transactions. A Merkle tree creates a sort of summary for all that data, a single root value.
A summary. Okay, so how does that help? Like if I wanted to check if a specific transaction is valid.
You don't have to download the whole block, which could be very large. You're given a specific path of hashes within the Merkle tree leading up to that root. You recalculate the hashes along that path.
And if it matches.
You've confirmed your transaction is part of the block, hasn't been altered, efficient and secure.
That is really clever. Now, the other thing Turner really emphasizes is the distributed nature of blockchain networks. What makes it so important that this ledger is spread across multiple computers, especially when we talk about cryptocurrency.
That decentralization is key. Instead of one central authority, like a bank holding all the records, a blockchain network has numerous computers, or nodes.
Nodes, just for our listeners, we can think of a node as basically just a computer on this network, right?
Right, and they each hold a copy of the blockchain, constantly communicating with each other. This has several advantages.
Okay, like what?
First, security. No single point of failure. Hackers can't just target one place. They would need to control a majority of the nodes to compromise the network.
Yeah, that would be
Prohibitively difficult and expensive. Then there's transparency. Anyone can verify transactions because the data is on all those nodes.
open for everyone to see.
Exactly. Then, reliability. Some nodes can go offline and the network keeps functioning because the data is everywhere. And perhaps most importantly, this removes the need for that central intermediary.
No need for a bank to tell us what's what.
Right. Trust is built into the technology itself, and that was a big part of the original vision for crypto.
Okay, so we have this blockchain, this decentralized, secure, and transparent ledger. How does this become cryptocurrency? What's the magic ingredient that turns this record-keeping into digital money?
Well, Turner defines cryptocurrency as a digital currency that uses blockchain technology to secure and verify transactions.
So far, so good.
The key difference: cryptocurrencies operate without those intermediaries we talked about, like banks. It's the network itself that validates and records those transactions.
No middleman, peer-to-peer. And wasn't Bitcoin like the first one to do this? Launched back in 2009, right?
You got it. Created by the mysterious Satoshi Nakamoto, Bitcoin emerged in the aftermath of the 2008 financial crisis.
A real statement, I guess, about wanting an alternative.
An electronic cash system, independent of central banks or any financial institution, giving individuals more control over their money. And since then, the field has exploded.
Exploded is right. Last I checked, there were how many cryptocurrencies? Thousands, right?
By 2022, over 10,000, many with significant market value.
And the combined value of all these cryptocurrencies is, well, enormous. It's mind-boggling.
As of April 2023, the total market capitalization surpassed $1.2 trillion. Bitcoin and Ethereum are the giants, accounting for the lion's share of that value.
Okay, so we have this foundation, the blockchain. We understand what makes a cryptocurrency. Now, Turner gets into the inner workings, the tech that powers these different cryptocurrencies, and it seems like that's where the real differences emerge.
Exactly. Think of it like this. They all share the same foundation, that blockchain technology, but the specifics of their design, their code, how they function, well, that's where the distinctions lie.
Okay, walk us through it.
Turner highlights consensus algorithms, the rules for agreeing on valid transactions, as a key differentiator. Also things like block time and block size. These impact how fast and how much the network can handle.
Let's tackle those consensus algorithms first. Why are they so critical in this decentralized system?
Good question. Remember, there's no central authority in a decentralized network. No one in charge of saying, yup, this transaction is legitimate. So, consensus algorithms. Those are the mechanisms that allow the network, all those nodes, to reach an agreement.
On what exactly?
On which transactions are valid and what the current state of the blockchain is. It's essential for preventing fraud and keeping the ledger accurate. Turner focuses on two primary types: proof of work, or POW, and proof of stake, or POS.
Proof of work, that's the one everyone's heard of, right? The whole mining thing. Break it down for us.
Right. With POW, participants, called miners, compete to solve complex computational puzzles.
A digital race.
In essence, yes. The first to solve it validates a new block of transactions and gets rewarded with newly minted cryptocurrency. They basically earn the right to add the next page to the ledger and get some coins for their effort.
So how does this puzzle solving actually work?
They're looking for a specific number, a nonce. When this nonce is combined with the block's data and put through a special function, it creates a specific result. Like maybe it has to start with a certain number of zeros.
A very specific outcome.
And finding that nonce, that's what requires all that computing power, why you see those huge mining operations.
So it's basically security through brute force. The more computing power a network has, the harder it is to attack it.
Exactly. To attack a POW blockchain like Bitcoin, you'd need to control more than 51% of the network's total computing power. Practically impossible for a well-established network.
I see. But I know there's a big downside to POW, right? Energy consumption.
That's a major concern. All those computers churning away, using massive amounts of electricity. It's not good for the environment. Turner points out that solving these puzzles can take approximately 80,000 times more computational power than a typical credit card transaction.
Wow, 80,000 times. That's a lot of energy just to process, what, a single Bitcoin transaction?
Yeah, it puts it into perspective. There's also the problem of electronic waste. All that specialized mining hardware becomes obsolete pretty quickly as the difficulty of the puzzles increases.
Right, constantly needing to upgrade. Not a good look environmentally.
Not at all. And then there's the risk that mining power could become centralized in large pools, potentially a threat to the whole idea of decentralization.
Interesting. Okay, so what about the other algorithm? Proof of stake. How's it different?
Completely different approach. No mining, no computational race. It relies on how much cryptocurrency the participants hold. These are called validators.
Okay, so instead of solving puzzles, it's about how much crypto you own.
Essentially, yes. The amount you stake, basically, lock up as a form of collateral, determines your chances of being chosen to validate transactions and create new blocks.
So the more you stake, the more, say, you have in the network.
In a way, yes. And if you try to approve fraudulent transactions, you risk losing a portion of your stake. A strong incentive, to be honest.
Makes sense. And I think Ethereum switched to this recently, right?
They did. Ethereum is now a POS system. A big move.
What are the advantages? I'm guessing it uses less energy.
Definitely. No need for all that mining hardware. Transactions can also be processed faster, potentially. But Turner points out a potential issue. Over time, it could become more centralized.
How so?
Those with the largest stakes, the wealthiest holders, could end up with a lot of power in the validation process.
Right. Interesting trade-off. Okay, so we talked about how the network agrees on transactions. What about block time? Turner mentions that as another key technological factor.
Block time is simply the average time it takes for a new block of transactions to be added to the blockchain. Bitcoin, about 10 minutes. Ethereum, much faster, around 12 seconds. Litecoin, somewhere in between, around 2.5 minutes.
So shorter block time means transactions get confirmed faster.
Generally, yes, but there's a trade-off with security.
Meaning?
Longer block times allow more time for the network to verify transactions across more nodes. Potentially more secure?
Right, more time to check everything carefully.
Shorter block times are quicker, but might not be as thoroughly vetted. It's a balancing act.
Got it. And then there's this block size. What's that about?
Block size refers to how much data a block can hold, the maximum amount of transaction data. Bitcoin has a limit of 1 megabyte, while others, like Bitcoin Cash, have much larger limits.
Does that matter in practice?
It can. Smaller block sizes can lead to congestion, especially when things are busy.
Like rush hour on the blockchain.
Right. Transactions get delayed and fees go up as people basically compete to have their transactions included in that limited space. Larger block sizes. Well, they can handle more transactions, but they require more powerful hardware to manage.
And if not everyone can run a node.
It can lead to more centralization as fewer, more powerful entities control the network.
Okay, so there are trade-offs with all these design choices. It's not as simple as it might seem at first glance.
Exactly. And this is all before we even get into the risks and challenges of cryptocurrency, which Turner spends a good deal of time on in his thesis.
Right, we've talked about the potential, the upsides, but there are definitely downsides to consider.
Absolutely. It's important to have a balanced perspective. Turner identifies energy consumption, which we touched on, government involvement, and cryptocurrency crimes as major areas of concern. These need to be addressed if cryptocurrency wants to be viable in the long term.
Yeah, let's go back to that energy consumption issue for a moment.
Yeah.
The numbers you mentioned earlier were pretty staggering. Does Turner offer any further insights into why this is such a big deal?
Well, beyond the raw numbers, Turner emphasizes the growing public awareness and concern about climate change. The perception of crypto, especially POW systems, as being bad for the environment is a real obstacle to widespread adoption. And then you have governments who may be reluctant to support something that contributes to the problem.
Yeah, no one wants to be seen as being on the wrong side of that issue.
Right. And the comparisons are stark. Turner notes that a single Bitcoin transaction can use as much energy as hundreds of thousands of Visa transactions or tens of thousands of hours of streaming video.
It's an eye-opening way to visualize the scale of the energy use. And it's not just the energy itself, but also the e-waste generated by all that mining hardware.
That's right. All those specialized machines, the ASICs, become obsolete so quickly. It adds to the global problem of e-waste.
A growing concern. So, environmentally, there are some big question marks. What about governments? It feels like the regulatory landscape is constantly shifting, which must make things even more uncertain.
It does. Turner highlights the wildly different approaches governments around the world are taking. You have El Salvador, which has gone all in on Bitcoin, making it legal tender. And then you have China, which has basically banned all crypto activity.
Talk about opposite ends of the spectrum.
Right. And then you have everything in between. Switzerland has historically been more hands-off, while the U.S., with the SEC and other agencies, has become much more active scrutinizing crypto offerings.
So what's the core issue for governments? Why is it so hard to regulate something like cryptocurrency?
Because it's designed to operate outside traditional financial systems. There's no central authority, no single point of control. It's hard to track transactions, to implement taxes.
Even with all the talk of blockchain transparency, it seems like there's still ways to obscure things.
Well, there's the pseudonymity provided by wallet addresses. You don't necessarily know who's behind those transactions, and there are ways to make things even more opaque, using things like Bitcoin ATMs or mixing services.
Bitcoin ATMs mixing services.
Yeah, with Bitcoin ATMs, you can convert cash into cryptocurrency without going through a traditional exchange. And with mixing services, you can essentially scramble your transaction history, making it harder to trace the origin of funds.
So more ways to add layers of anonymity. And that anonymity makes tackling crime a whole other issue, doesn't it?
Absolutely. Turner talks about the risks of hacking, people trying to steal cryptocurrency from exchanges or individuals' digital wallets using malware or phishing scams.
Malware, phishing, we're all familiar with those tactics from the online world, but now they have real financial implications.
Right. And while there are security measures like two-factor authentication and encryption, they're not foolproof. And then there's money laundering.
Great. The elephant in the room. How big of a problem is that?
The anonymity that crypto offers makes it attractive to criminals. It's harder for law enforcement to trace the money trail.
And it seems like there are tools specifically designed to make those transactions even harder to track.
Unfortunately, yes.
Okay, so we've got these major challenges: environmental impact, regulatory hurdles, the potential for criminal activity. Terner argues that addressing these things is essential for long-term viability. So what does he think will actually determine whether cryptocurrencies survive?
Well, he emphasizes that the future is far from certain. He sees a lot of potential in the technology, but he also lays out these risks.
Okay, but potential is one thing. What about reality?
He argues that continued innovation, wider adoption, and crucially addressing these risks will be key. He looks at where the market is now, what people think about crypto, and the emerging trends in the industry. All these factors will play a role.
Let's start with the market. It's been incredibly volatile, hasn't it? I mean, huge price spikes followed by massive crashes. It's enough to make anyone nervous. What does Terner say about that?
He highlights these dramatic swings. Remember the pandemic, increased online activity, government stimulus. Bitcoin soared to an all-time high of $65,000 in late 2021. But then, in 2022, a sharp decline, dropping below $20,000.
A huge drop. What does he attribute that to?
Mostly macroeconomic factors, rising interest rates, inflation concerns. He makes the point that traditional markets, like the S&P 500, saw much smaller declines during that same period. Crypto is just inherently more volatile.
Okay, so maybe not the most stable form of currency. And then you have events like the FTX collapse. I imagine that had a huge impact on public trust.
It did. Terner cites surveys, including one from CNBC, that showed a big shift in sentiment. Negative views of crypto surged, positive views dropped significantly, and there was this growing support for stronger regulation.
Right. Even among crypto enthusiasts.
Well, the survey showed that a majority of respondents, even those who were generally favorable towards crypto, wanted to see regulations similar to those for stocks and bonds.
Interesting. It seems like people are starting to realize that some level of oversight might be necessary. So, given all that, what direction does Terner see the crypto world heading in?
He points to increasing regulation and government oversight as a clear trend. Globally, authorities are paying more attention to the risks, and they're developing new rules for crypto. The US SEC, the Financial Action Task Force, they're all getting involved.
To try and rein in this decentralized world.
In a way, yes, but it's not without its challenges. Some of these measures clash with those core principles of decentralization and anonymity that many crypto proponents value.
Right, that tension we keep coming back to.
Exactly. Terner talks about things like requiring crypto service providers to collect information on larger transactions, something that would directly impact the privacy that many users expect.
And what about innovation? Terner mentions things like NFTs, which have gotten a lot of attention recently.
Right, NFTs, non-fungible tokens, these are basically unique digital assets that can represent ownership of things like digital art or even real-world items.
So using blockchain for something other than currency.
Right, and it's certainly an innovative use of the technology, but Terner points out that they share many of the same risks as cryptocurrencies. Regulation is still unclear, prices are volatile, and there's potential for fraud.
So innovation doesn't necessarily solve the core issues?
Unfortunately not. Which brings us back to that central question. Does Terner think crypto will ultimately make it?
What's the verdict? Thumbs up or thumbs down?
Well, he doesn't give a simple yes or no. It's more nuanced than that. He acknowledges the potential benefits, the decentralization, the transparency, but also the risks.
The risks we've been discussing all along.
Exactly. The volatility, the security concerns, the regulatory uncertainty, the need for broader adoption. It's all a big balancing act, and it's too early to say for sure how it'll all play out.
Okay, fair enough. But he does explore what widespread adoption could mean if it were to happen, right? What are some of the broader societal implications he sees?
He suggests the possibility of a more decentralized financial system that could potentially benefit people who don't have easy access to traditional banking services.
Financial inclusion, as they call it.
Right. But he also cautions about the potential for increased criminal activity, like money laundering, if there aren't proper safeguards in place.
Which is another reason for regulation, I suppose. What about the impact on governments and the existing financial system?
He suggests it could create challenges for governments, for central banks, especially when it comes to monetary policy. Might see more regulations, even bans in some places.
Will pushback from those in power?
Possibly. And economically, we could see less reliance on traditional banking services, but also maybe established financial institutions will start investing in crypto and blockchain technologies.
Which could lead to growth in those sectors.
Yep.
Interesting. So many possibilities.
A lot of unknowns for sure.
We keep circling back to this tension between decentralization and the need for some sort of regulation. Like, they're fundamentally at odds with each other.
They are. Turner really emphasizes that. How can these systems, which are designed to operate without central control, coexist with governments, consumer protection, financial stability? It's the big question mark.
And right now, it seems like the trend is towards more regulation, not less.
It does seem that way. Most countries haven't outright banned crypto, but they're putting rules in place. It suggests that there will be some sort of compromise. Crypto won't be completely free from oversight, but it won't disappear either.
A middle ground of sorts.
Perhaps.
One last question. What about using cryptocurrency as an actual currency for everyday things? Is that realistic?
Turner thinks the volatility is a major obstacle. To be a practical currency for everyday use, it needs to have a relatively stable value. And right now, most cryptocurrencies don't. They fluctuate too much.
Which makes it hard for both businesses and consumers to rely on it.
Exactly. Imagine trying to price things or pay your bills when the value of your money is constantly changing.
Makes sense. It seems like we're still a ways off from using Bitcoin to buy coffee every morning.
Probably. And then, of course, there are those two big issues we talked about: the environmental impact and the potential for criminal activity. Those need to be addressed, too, for cryptocurrency to gain wider acceptance.
And are there any signs of progress on those fronts?
There are efforts being made. Turner mentions things like the Crypto Climate Accord, which is pushing for the use of renewable energy in mining, and regulatory bodies are working on new rules and frameworks to combat illicit activities, especially after events like the FTX collapse.
So some positive steps, at least. It sounds like Turner's thesis doesn't give us easy answers, but it does give us a really good understanding of the complexity of this whole cryptocurrency landscape.
I think that's a good way to put it. He lays out the potential, the challenges, and the key factors that will shape the future. It's up to us as individuals and as a society to decide how we want to navigate this new world.
Well, this has been a fascinating deep dive into Elliot Turner's work, a lot to think about. And on that note, we'd like to leave you, our listener, with one final provocative thought. Given this inherent tension we've been discussing, this pull between decentralization and regulation, what fundamental shifts might be needed for cryptocurrency to truly go mainstream? What would it take for it to become more than just a speculative investment? It's a complex question with no easy answers, but one that's worth pondering. Thanks for joining us on The Deep Dive.